Today on InvestTalk, we talked about escalating tensions within the tech sector between the US and China, answered questions on Ring, Walmart, and Devon Energy, and ended the day talking about meme coins.
This is InvestTalk, independent thinking, shared success.
Let's get right to it and talk about my main focus point today, which is about the new blockade on tech by the Biden administration that is likely to be continued into next year. Now, the US is tightening the screws on China's tech industry. This week, the Biden administration announced new export restrictions on advanced semiconductors, aiming to limit China's ability to produce cutting-edge chips used in AI and advanced weaponry. The new rules target 140 entities, including Chinese chip makers like Piotech and Sea-Carrier. These restrictions are also extended to firms in Japan, South Korea, and Singapore. Additionally, controls now cover 24 types of chip-making equipment and specific software tools essential for semiconductor production. The current Commerce Secretary, Gina Raimondo, stated these moves are part of a strategic effort to address China's military modernization. National Security Advisor Jake Sullivan reinforced the message, saying that the U.S. will aggressively safeguard its technology to prevent adversaries from undermining national security. Now, China, for what it's worth, quickly condemned these restrictions, accusing the U.S. of abusing export controls and hindering normal trade. A spokesperson for China's Ministry of Commerce vowed to defend the country's interests, and the impact isn't really just limited to China. Dutch chip equipment giant ASML said the restrictions could affect its sales of deep ultraviolet lithography systems to China. ASML already cannot sell its most advanced machines, known as extreme ultraviolet lithography, due to earlier restrictions. Now, these export controls come just weeks before Donald Trump returns to the White House, but it's important to note that the Trump administration is expected to adopt an even tougher stance on China. Analysts believe the latest measure may really just be a preview of more aggressive policies to come. And as the US-China tech war escalates, the semiconductor industry kind of finds itself squarely in the middle. And so for now, the US is drawing what is a hard line on protecting its technological edge on national security grounds. And the world is bracing because it is, again, not just going to affect China, but all the trading partners, and may have widespread effects on global trade for years to come. Let's talk about the market today. U.S. stocks finishing mixed, though mostly higher. The Dow down 28 basis points, S&P 500 up 25 basis points, NASDAQ up 81 basis points, and Russell 2000 up 54 basis points. Overall, major indices were mixed for the week, with tech really driving the S&P and NASDAQ strength. The equal weight S&P lagged by more than 200 basis points on the week. Big tech mostly higher again today, while other outperformers included retail apparel, software, semi-cap equipment, auto parts names. Relative underperformers, included energy, industrial and precious metals, managed care, and life insurance. The dollar index was up 30 basis points. Gold finished up 40 basis points as well, while crude oil settled down 1.6%. Non-farm payrolls rebounded from October's strike and weather impacts, though the mixed report also saw higher unemployment rate than expected and a downtick in labor force participation. The unemployment rate uptick really supportive of a December rate cut, which is now priced at an 85% probability as a market close. Earnings calendar still busy, with latest batch of consumer and tech results fairly well received that could drive continued upside moving forward. Also, some focus on largely upbeat commentary surrounded holiday shopping season and the late week pickup in the expectation of China's stimulus implementation. At the same time, markets really still processing the valuations, which do really look kind of stretched at this point. Renewed concentration scrutiny, also a concern, and uncertainty surrounding Trump 2.0 policies. On the consumer sentiment front, Michigan consumer sentiment beat with the big upside from current conditions index, though expectations index weakened, and the one-year inflation expectation actually jumped 30 basis points to 2.9%, the highest it's been in 6 months. Summing up the week on the bullish side, again, non-farm payrolls increased, ISM manufacturing, the highest it's been since April. Atlanta Fed GDP Now estimate of Q4 growth ticked up to 3.3% on Thursday from the initial 2.7 estimate at the end of October. December rate cut probability jumped, as I mentioned, to about 85%. Flow data continues to support U.S. equity strength, while U.S. equities attracted a ninth straight week of inflows. Visa also said consumer demand has remained healthy in December. Now, on the bearish side, household survey showed a 355,000 decline in the number of employed people. Unemployment rate, like I said, unexpectedly ticked up to 4.2%. ISM services fell to its lowest level since August. And tariff risk also out there in the headlines, with Navarro's pick as Trump's top trade advisor, as well as big tech's, the idea of big tech's crackdown, or rather the crackdown on big tech, persisting under the next Trump administration with his pick to head the Justice Department's antitrust division. Not much in terms of macro data next week, though CPI and PPI coming in the middle of the week, and certainly we will be there with all of that.
Hey, this is Don from Durham, North Carolina. Love the show. I know you like gold sort of medium and long term. I was wondering what you think about the technical setup of Ring, R-I-N-G. It's the iShares Global Miners ETF. Just wondering what you think about technical setup over the next month or so. Thanks. Bye-bye.
So taking a look at Ring. Ring is, as was mentioned, the iShares MSCI Global Gold Miners ETF. It's a fairly large fund, just under $1 billion, and it has an expense ratio of about 39 basis points. And what it does is it gives you exposure to gold mining companies as classified by GICS. It has a minimum of at least 30 securities and does not hedge to gold prices. And so if you take a look at this fund right here, right, it's pretty well spread out, actually. As is the general profile of gold miners, right? So about 53% large caps, 26% mid caps, 17% small caps. So it tends to tilt towards some of the smaller names, which is certainly something that we like. Now, its revenue comes from all over the place, right? Most of it comes from Canada, some from the UK, the United States is the third name, and really all the way down the spectrum. It's pretty well diversified with respect to revenue. Now, in the way that it is not well diversified is with respect to the concentration within the top three names, right? Newmont Corporation, Agnico, Barrick Gold. That makes up a whopping roughly 43%, 44% of the portfolio under those three names. And so one suggestion I would have is, well, if you're going to invest primarily 50% of your allocation to this in those three names, maybe just invest in those three names. Maybe don't pay the 39 basis points to get exposure to this fund that is incredibly top heavy and in reality only has about 40 names in its holdings. And one other thing to consider is, well, what is the prospect for gold moving forward? You know, we've had a historic run up in gold this year, and it pared back a little bit in the month of November. And we know that for any security that is related to an underlying commodity, the price of that security is generally going to follow the trend, not necessarily the magnitude, but the trend of that underlying commodity. And I do think in the medium to long term, gold is probably going to continue to do well. We're seeing a rise of geopolitical uncertainty in the Middle East, in sub-Saharan Africa, some areas of Latin America. And anytime there is geopolitical uncertainty or any uncertainty at all, right, gold tends to do well, especially as rates come down. And so with that all in mind, I think that now, even with this run up, though we are ripe for a pullback, I would keep on my mind increasing some of my exposure to gold and to gold miners. But you know what? If you're going to invest in a fund that is pretty much half invested in three names that are going to make up some of the largest names within the gold mining space, I just personally wouldn't pay the 39 basis points. I would just have some exposure to those three names, those big names, all over 10% in this fund that is ticker RING, the iShares MSCI Global Gold Miners ETF. You probably noticed that we are answering questions submitted by viewers to our YouTube channel. And that's because we really appreciate when our listeners become viewers and our viewers remain listeners. And we really just appreciate everybody that takes part in this whole InvestTalk family. And so when you're over there on our YouTube channel, that's InvestTalk with 2 T's, and you leave a question in the comment section, we like to get to those, well, as soon as we can. And so this one came in the other day. It says, I wanted to know what you guys thought of FTNT. I know it's near a 52-week high, and I wanted to see what price would be a good value to get in if the stock gets below the $90 range. And so FTNT is a cybersecurity solutions company. They work with businesses and enterprises to offer cybersecurity solutions. They're made up of three businesses: their technical support, their security subscription service, and their network security applications. And so that's kind of evenly split between the three divisions. Now, its growth has been pretty substantial since 2018, from 1.8 billion in revenue to 5.8 billion is where it's projected to be this year. And in that time, margins have been expanding as well, from 18.4% net margin, projected to be almost 30% this year. Cash flow looks pretty positive. They've been buying back shares. Earnings have been consistently upgraded, and they have very minimal debt. They're a $75 billion market cap company. They only have about 994 million in debt, and that's down from 1.05 billion back in 2021. So they've been paying down that debt, which does not weigh heavily at all on their balance sheet, because you know what? Their interest coverage ratio is 93 times. And so once again, we find ourselves in a situation with Fortinet where the stock has surged pretty substantially in the past 52 weeks due to that growth. 91.41%. Q3 earnings showed 6.1% year over year growth in billings. That's pretty substantial. There was also a partnership with CrowdStrike, which kind of put it in a position to give it access to new consumers, right? This is one of the things that has been driving this growth. And so with all that in mind, it is pretty expensive. It's price to book value 83 times, price to cash flow 38 times, 13 times price to sales. Not where it has been in terms of it at its height, right? It was trading it 20 times in the past 5 years. It was trading it 80 times forward-looking price to earnings. And so it has come down a bit. But you know what? Growth has also come down a bit. They grew from 1.8 billion to 4.4 from 18 to 22. Nearly doubling. That's slowed from 4.4 to 5.3 and 23, 5.8 this year. Margins are expanding. Yes, cash flow is looking good, but that's also slowed as well. And so with that in mind, I think this is a solid company. They got a very solid balance sheet. They're not diluting shareholders. They're not issuing a bunch of debt. They're running it internally based upon cash flow that's coming into the company, but it still looks a little expensive for me. But you know, a lot of the market looks expensive right now. So I would keep it on my watch list. Maybe if it does come back below that 90 level, it could even, given the recent run up, come back below to that 80 level. I think 80 to 85 would probably be a better entry point here. Thanks for watching. Let's keep things moving and pivot back to the InvestTalk voice bank for this call that came in earlier.
Hello, InvestTalk. I was calling in with a question regarding Walmart. The symbol is WMT. Wanted to get your thoughts and opinion and what would be a good entry point. I'll be listening to the show for the answer. Thank you.
Well, I don't think I have to tell anybody about Walmart, but I'll remind you all regardless. And Walmart is one of the largest retailers on planet Earth. They have brick and mortar stores. They have really been moving into e-commerce in the past couple years. They operate through Walmart, Walmart International, Sam's Club, all these different brands that feed into the parent company, Walmart Inc. And so it's an incredibly large company, right? It's a $766 billion market cap company. And with that, they have very little debt, $61 billion in debt. Now, they pay a dividend. They pay a consistent dividend. And the dividend has been growing from 69 cents back in 2019, projected to be 84 cents this year. Now, like a lot of these big retailers, it's been doing really well this year, up 82% year to date, 82%. But also, like a lot of these retailers, they operate on some pretty slim margins. Net margin projected to be about 3% this year. And growth is good. It's not knock it out of the park good, but you know what? There was a migration, or rather an effect felt by the lower income spectrum, more so than middle and higher income earners. And so a lot of that revenue is driven to Walmart out of necessity. And so there are some headwinds moving forward, right? As the economy continues to recover, people will generally tend to spend less at a Walmart, right? Less at a Dollar General, though that's way cheaper, and move back towards where their original spending patterns were, as they think less about saving money. But my biggest problem with Walmart isn't any of that. My biggest problem with Walmart is right here. It's trading at 35 times forward-looking earnings. This is the most expensive it has been in 5 years. Price to cash flow is about 20 times, nearly the most expensive it's been in 5 years. And so I tend to agree with the target price here around 97. I think that given the growth here, right, given the headwinds we have here, even with what has happened over the past year, which has been phenomenal for this company, right? They are a cash cow. All they do is generate cash and buy back shares and pay out dividends and grow their business. I just think it's too expensive. And so I'm going to keep Walmart on my watch list. I think you should keep it on yours as well. Let's go to Dave from Ohio, who has a question about ticker DVN. Do you own it or are you looking to buy it?
I've owned it for a couple of years, and I was thinking about adding to it, and I was just going to get your take on it.
Yeah, of course. Well, Devon Energy, ticker DVN, is an exploration, development, production, oil and natural gas company. We actually own it for clients. And one thing that is important to note about this name is that it is trading at incredibly low multiples, right? Only 7.8 times price to earnings, 1.7 times its book value, 3 times its cash flow, nearly where it has been, or nearly at the bottom of its range over the past 5 years. And in the past 3 years, their cash flow has been pretty solid. Their cash flow yield is solid as well. Their dividend, also pretty strong. It's fallen, but they still pay about a 3.5% dividend yield as it stands right now. It's important to note the dividend has fallen from $2.87 last year, projected to be about $1.56 this year. And margins started to compress a little bit as well. But the reason why is something that I've already mentioned today, is that when you're investing in a company that is tied primarily to an underlying commodity, well, it's going to track the supply and demand dynamics of that commodity. And so with Chinese oil energy demand low, with a new administration that is likely to be very friendly to increasing the efficiency of getting some of these products to market, it stands to reason that now could be a good time to pick up names like Devon Energy. Now, the reason why I like Devon Energy versus some of these other energy names is, well, it's pretty evenly split 50-50 between oil and natural gas. I think natural gas is going to be a big beneficiary over the next 3-4 years from the next administration, more so than maybe oil has, right? Oil has not even fully utilized all the permits that it has, right? Some of the benefits that can come to the natural gas space is increasing the efficiency of the pipeline system, making it easier and cheaper to deliver product to market. And so, like I said, we own it for clients. In the short term, it's probably going to go through a little bit more, headwinds just because of the global dynamics. But if you're in it for the long term, I think Devon Energy is a good way to go. Thanks for the call. Now, I talked briefly about this topic earlier in the week, or maybe last week, but regardless, EU defense spending has soared amid geopolitical tensions. The European Union, or rather countries in the European Union, right, the separate countries, but in aggregate are poised to increase their combined defense budget to 326 billion euros, roughly $342 billion in 2024, a 16.8% rise compared to the previous year, reaching a record 1.9% of the bloc's GDP. This surge reflects heightened concerns over security threats, particularly following Russia's invasion of the Ukraine. So how is this developing? Well, the first way is a boost in procurement. EU nations are projected to spend over 90 billion on new defense projects in 2024, a significant increase from the 61 billion they spent in 2023. This marks really a focus on modernization and replenishing a broad array of military equipment. Defense contractors are really set to benefit substantially. And we're not just talking about ones within Europe. Many of the orders in recent years have actually been placed with non-EU manufacturers. And so this highlights not only the fact that there is a gap in terms of what they need versus what they have, but there's a gap in the bloc's ability to be self-reliant. There's also a push for more collaboration. There's a need for EU nations to collaborate on defense projects, which can be beneficial for all participants because it overall can reduce costs and enhance the strategic independence by relying more on European arms makers and their European partners. This newest investment surge seeks to offset underfunding from 2011 to 2018, which really delayed key military programs. And because that's the case, really much of what the current spending is directed towards is completing those stalled projects rather than launching new initiatives. The increased defense spending really reflects a overall broader shift in how the EU is creating its priorities as member states respond to evolving security challenges, signaling robust opportunities for defense contractors, and a renewed emphasis on European defense collaboration. And so with all of this in mind, it's important to note some of the key drivers geopolitically that are driving some of these spending decisions of international economies and how that could affect us as investors. It is Friday, and one of the best parts of Friday is that we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list now. The 2-year Treasury yield was at 4.108%. For perspective, 2 weeks back, it was 4.373. 18 weeks back, it was 3.882. 56 weeks ago, it was 5.05. And 154 weeks ago, almost 3 years ago, it was 64 basis points. The 10-year Treasury yield was 4.164% today. 2 weeks back, it was 4.414. 14 weeks ago, it was 3.921. 56 weeks back, it was 4.63, and 150 weeks ago, it was 1.762. Gold was priced at $26.34 per ounce today. 2 weeks back, that number was $27.08. 56 weeks back, it was $19.35, and 144 weeks ago, it was $18.06. Silver today was at $30.99 per ounce. 2 weeks back, it was $31.24. Last week, it was $31.24. 2 weeks back, it was $30.32. 42 weeks ago, it was $22.80. And 137 weeks ago, it was $23.94. Oil was selling for $67.42 per barrel. 2 weeks ago, it was $71.28. 10 weeks back, it was $67.79. 52 weeks ago, it was $74.30. And 152 weeks ago, it was $66.62. The national average for a gallon of regular gasoline is $3.03, a 3-cent decrease from 2 weeks ago. 79 weeks back, that was $3.56. 127 weeks ago, it was $4.25. And 147 weeks ago, it was $3.57. In California, it was averaging at $4.37 per gallon, a 7-cent decrease from 2 weeks ago. For comparison, in Florida, gas was averaging $2.98 per gallon today. That is $1.39 less per gallon than gas in California. Let's keep things moving and play another fresh caller question from 888-99-CHART.
I have a general question about analyzing a company and their debt. How do you analyze a company's long-term and short-term debt? How do you know that they have too much debt on their balance sheet or their debt is justified? I just wanted to know if there's any kind of quick ways to look into this. Looking forward to your answer on that. Thank you.
So that's a great question, because we talk a lot of times about a company's balance sheet, what's healthy, what's not healthy. And so at a high level, not all debt is bad. In fact, debt leverage within your company is what magnifies returns, right? Not all debt is bad, but not all debt is the same. You could have a company that has $100 billion in debt that has an interest coverage ratio of 30, or you could have one that's $100 billion in debt with an interest coverage ratio of 1. You could have debt that is short-term in nature. You can have debt that is long-term in nature. A lot of the largest companies push out their debt decades, right? And so the interest cost on an annual basis that they're paying, well, it doesn't really affect the health of that company. And so when you're looking at a company's debt, first the profile matters. How much is short-term? How much is long-term? What is the interest that is actually being paid on this debt? Because that's what's going to affect year over year. And when is it maturing? Generally, companies tend to roll these things over and over. Another is, well, when was it issued? What is the rate that affects the interest payment? But when we're talking about leverage, we're talking about how much wiggle room a company has, right? The economy is cyclical. Markets are cyclical. Everything in life is cyclical. And so when there are downturns, companies that have higher debt levels are going to struggle compared to companies that do not. And that's because the degree to which you lever a company is going to affect how much wiggle room you have in terms of what you earn versus what you have to pay to stay in business. Now, you also aren't looking at all this in isolation. A utility company is going to carry far more debt than a video game maker, generally speaking. And so when you look at these numbers, a helpful thing to do is do a comp analysis. Look at other companies within that specific sector. Try and find companies that have the same type of products, the same type of customer bases, a lot of things in common and see how they compare. Now, I know I threw a lot of information out at you, but that's just to say that there is a lot that goes into understanding the importance and understanding what it means when you're looking into a company's debt. And so hopefully that gives you a little bit of where to start, because that is one of the most important aspects of a company. How is it funded? How is it capitalized? How much risk are they taking? Thanks for the call. Now, investors' enthusiasm for artificial intelligence stocks may have gone a little too far, raising the risk of a market correction. Vanguard's chief economist, Joe Davis, warns that while AI has transformative potential, the current market is kind of overestimating the near-term impact. Davis notes that while there's a 60 to 65% chance AI could be more impactful than the personal computer, the stock market's really pricing it closer to 90%. AI-linked stocks have been central to Wall Street's rally this year, really the driving force. The S&P 500 is up 27%, driven in large part by NVIDIA, which has surged over 180% and contributed almost a fifth of the index's gains this year. Other big tech firms heavily investing in AI have also seen significant boosts, while companies like OpenAI are securing sky-high valuations. Now, Davis draws a historical parallel for us all, suggesting that the current market valuation really resembles 1997, just before the dot-com bubble burst in 2000. Even if AI really proves to be as revolutionary as some say, it doesn't necessarily mean, and this is something I've been saying for a while, it doesn't mean that the stocks that are leading the boom today are going to be the ultimate winners. I have said that some of the best ways to invest in AI, some of the best ways to invest in that theme, isn't taking on some of the outsized risks of trying to pick the winners in a sector that tend to be winner take all. You can also invest in the biggest beneficiaries, right? The healthcare space, finance, utilities, all industries that are going to benefit by the applications that the tech firms are developing with these models, with artificial intelligence. Now, with all that being said, as with everything, predicting timing of a pullback, it's hard, if not impossible. But a correction in AI stocks could occur even if the technology ultimately transforms the economy, just because of the degree to which the market is already pricing those changes. And so for now, the hype remains strong. It is driving the market higher and higher. But just because things are all rosy, and in fact, when things are the rosiest, you should probably be preparing in case things take a turn.
Hey, that was quick. Hey, Luke. Happy December. There's a stock, I own a fair amount of stocks in my portfolio, and I have taxable account. I have a traditional IRA, which is smaller, and then Roth IRA. And I own a little bit of this in each of those, a little more in my taxable account because it's larger. But I sold some recently. I bought it like below 90 in the last 2 years, 1 and 2 years ago. And, it's recovered so well, and it went all the way up to almost 200. I sold some at 186, just a little. But how do you look at it long term? And what do you think the near-term trend is with this, seeing as it's come up so much relatively quickly?
Well, I'm not sure that I heard the first part because I did not hear a ticker or a name.
Oh, I'm sorry. I thought the guy who answers the calls passed it on. It's Blackstone, BX.
Blackstone.
I beg your pardon.
No, not a problem at all whatsoever. Usually they do feed it to me, but sometimes we do things a little quick here. So for those of you who don't know, Blackstone is an investment fund management company. It is very large. It is very complex. It has lots of offerings. It has had a historic run this year in terms of asset management firms. It's done very well, but it is something that we are going to dive into after the break, because unfortunately we have to take our last one. But Bill, I promise you when we come back, I will talk all about Blackstone. Now, before the break, we got a call from our friend Bill in Northern California, and he had a question about Blackstone. And Blackstone is an alternative asset manager. They primarily invest in real estate, private equity, private credit more recently, hedge funds, the alternative stuff. They're actually the world's largest alternative asset manager. They have more than $1 trillion in assets under management. And they've been pretty strong from 2018 onward. And we'll talk about that in a sec. But the revenue growth has grown about 10% on an annualized basis over the past 5 years. Their margins, very solid, actually improved from 13% net margin to 30% this year. That's something you do see within the finance space, is although they do operate based on fees associated with their AUM, and fees are compressing, they tend to have a lot, or rather not much, overhead to run the business. So finance firms tend to have, asset managers tend to have some pretty good margins, pretty efficient businesses. Now in the past 52 weeks, it's up 66%, up 42% year to date. And so there are two things going on here. One is this is a company that is first-class company, first-class asset manager, especially within the alternative space. But one of the difficult aspects of these alternative asset managers that work in private markets is you don't really know much about what they hold. And so there are outsized risks there. You tend to only find out how risky those investments were when markets start to really go south, when they have to fire sale some of their holdings, right? BREIT didn't do particularly well. And so with that in mind, there hasn't really been a situation where a lot of these private credit funds, a lot of these private real estate funds really have to be shown the light. And that's one issue I have with Blackstone. Now there's fee compression. We already talked about it. Asset managers are really able to charge less and less than they ever have been. But the most pressing problem, even though, they have very little debt as a company, they're a $227 billion company with only $11 billion in debt. They generate a lot of positive cash flow. Their margins are expanding. It's really just how expensive they are. They're trading at 32 times forward-looking earnings. They're trading at 65 times their cash flow, 13 times sales. And so I imagine you've held on to it for a long time in a bunch of accounts, as you said. I certainly wouldn't think of buying any more. I would probably start aggressively trimming here because, like I said, when you have systematic stresses in the system, though there doesn't really seem to be anything like that on the horizon, that's when you really find out the risks that these private funds are taking. But generally speaking, it's just very expensive right now. Thanks for the call. Now, before we head off, I want to briefly talk about something that is all the rage right now, and that is meme coins. Since early November, cryptocurrency inspired by memes, everything from squirrels to dogs with hats to all these random things that people come up with, have really been all the rage. And that's in the wake of Donald Trump's victory, which has fueled the cryptocurrency area, the cryptocurrency sector broadly. Dogecoin, a very famous one that Elon Musk loves, certainly has had a wonderful time in the past month or so. But it's important to note, and something that I love to remind people of, that when you're doing this decentralized finance, these meme coins, you have to be incredibly careful. People always talk about the stories of hitting it rich quickly on these things that have no underlying value at all whatsoever, other than being associated with a meme on the internet. And so this too has parallels with the NFT boom and subsequent crash. It's hard to ignore. Most meme coins, 90% of them, have a market cap less than $1,000. Oftentimes, in a free society, there are people that take advantage of those who are just trying to better themselves. And this meme coin craze, it's a high stake game, and a lot of people that get involved don't understand it. And so once again, the cardinal rule, when something sounds too good to be true, it is. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, and please be sure to rate and review us on iTunes. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to InvestTalk.com and click the portfolio review button. This is a free and confidential service. Also, if you haven't optimized the potential for your 401k, well, guess what? We can help you there too. It all starts at InvestTalk.com. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.